It is down by 5.8%. The sharp drop-off was triggered by an unconfirmed Reuters report that Saudi Arabia could fully restore output within a couple of weeks. Of course, this is after the stunning attack this weekend that knocked out 5% of the global output. During a press conference within the last hour, Saudi Arabia's energy minister said the kingdom expects the Aramco deal to return to full production by the end of September. And for more on energy stocks, as well as a global look at your portfolio, we're now joined by Jay Bala. He's the senior portfolio manager at AIP Asset Management. Jay, nice to see you.
You too. Thanks for having me on.
Well, let me first get your top-down view. And I want to just remind our viewers, you do run a macro fund.
Correct.
So what's your sense right now as you look at all these different aspects?
Yeah, I mean, like the way we're looking at it, and we also run sort of a separately managed asset program for high net worth investors and retail investors as well. So we look at the world from sort of a portfolio perspective. And the one we're most concerned about is sort of our older client base, those that are retiring, those that are in retirement. And if you look at it, like portfolios were built 4 or 5 years ago on the basis that there would be interest rate normalization. We would eventually see 4 to 5% returns on bonds. We'd have 8 to 9% returns on equities. Now you have to sit down and reevaluate and look at the world and say, look, those days are never coming back. You're never going to have bonds yielding 4 to 5%.
Never?
It's not coming in the next 10 years, right? Like we've had it for the last 10 years. It's going to be for the next 10 years. And the only thing, you got to look at is look, if you're holding bonds, you're going to get 1 to 2% out of it. And if you're buying bond ETFs, hoping you're going to get something higher, you're probably not going to make any money on a bond ETF. You're probably going to get, the only thing you're doing is you're investing in duration risk. And I bet you most people are probably ill-equipped to understand duration risk and to manage it.
Well, I was just going to say, we should describe what that means. So, if you're going to tell our viewers they don't understand a certain risk, you got to say exactly what it is.
So duration risk works like this. So bond prices and interest rates are inverse. So a 1%.
Bond prices go up, the yields go down.
Correct. So if interest rates go up 1%, the price of your bond comes down 10%, assuming you have a 10-year term on it.
Okay.
Right?
So in other words, and this is actually really, we're kind of going in a different path than I thought we'd talk about, but that's okay because this does help people's personal portfolios, which is people don't really understand the capital loss that they can incur by owning certain bonds or bond funds, and that's what you're talking about.
Exactly. And so if you own an actual bond, like let's say you went and bought a Canadian Treasury bill, at the end of 10 years, you're going to get your money back plus your interest. If you hold an ETF with a 10-year duration on it, those bonds constantly get reloaded so that the ETF maintains a 10-year duration on it, which means you could just continuously keep losing money because it doesn't actually mature at any one point. Right? So there's no real value to holding a ton of that right now. And then if you look at the equity markets, I think the volatility is here to stay, right? You've got basically 2 or 3 things that are holding up the markets. No one really is looking at earnings anymore because corporate earnings is anemic. So the only thing really holding up the markets right now is the Federal Reserve. The hope that there's a China-US trade deal soon, right? Yeah. And neither one of those is happening anytime soon, right? You're going to get probably a dovish Fed.
Right.
Honestly, I'm really saying, look, if I was Trump and I'm getting elected in, November 2020, I'd probably want a trade deal somewhere in September, October.
Right.
The markets would rally. It'd be a very nice sail into a re-election. So why rush it, right? And then the China story is even broader than that, in that you're going to have almost 2 deals. You're going to have a deal that's done short term just to sort of alleviate market pain. And then the other one goes on for decades, right? At the end of the day, you've got 2 competing powers who want to kind of carve out the world in their own way. And nothing stops China from coming back 10 years from now and saying, you know what, I know we signed a trade deal. We're going to renege on all of that. New deal.
So where does that leave you then from an investing perspective? Obviously, you are not recommending investors own bond ETFs.
Right.
You might be able to own fixed income on your own as it relates to various bonds and bonds maturity, because you're going to get your money back, which is different than, to your point, ETFs. And again, people don't necessarily realize that. But how do you invest then for your clients today?
It's a good question. And I think we go back to sort of I guess, portfolio construction 101, which is diversify your portfolio. And so we've already gone through the two main categories, which is fixed income and equities.
Yeah.
Now start pushing outside of your comfort zone. Look at what a lot of the pension funds are doing. They're all moving into alternatives. They're all moving into real estate. They're all moving into private debt, private equity, things that are non-correlated to the market. Your portfolio has got to look a lot more like CPP than it does a traditional portfolio, right? Mm-hmm. And that comfort zone is going to be an education process. This is probably something you may not want to do on your own. You may want to buy some time from a financial advisor or find somebody that's an expert in this category and buy a few hours, mm-hmm. right? But get some advice on it is what we're pushing on.
But don't you think, Jay, that some of those areas to me have become very overcrowded? I mean, you have seen, and CPP is I think most people around the world in the pension fund community would say is one of the best out there, and they were early in terms of going into private equity and real estate, et cetera. Mm-hmm. I mean, so many of the U.S. companies, I used to cover them on Wall Street, they were very slow, the pension funds, and you're seeing that. But the point is, though, everybody else around the world is now kind of catching up a little bit to CPP and have been for the past couple of years, to the point where if you're looking to do some of these private equity deals, the price that you have to pay to get into those deals might not be warranted. The valuations are really quite high. So does that not leave our viewer, the retail client, perhaps at the end of the game, at the end of that cycle?
Not really. And so I'll say there's sort of two categories. There's private equity and then there's private debt. Yeah. And private debt's a relatively new one. And private debt is really what the banks do. They just do direct loans. They have security over assets, and they get a higher coupon on it, right? So a private debt fund might generate somewhere between sort of 7 to 10% yield, just because those are off-market loans and they're direct loans. And the private equity, I mean, the valuation always depends on what sector you're focused on. There's always a sector that's going through a transition, right? So if you were to buy oil stocks, say 6 months ago, or invest in an oil company 6 months ago, valuations probably weren't that bad, right? Right. Certain commodities are the same thing. But the difference with the private equity guys is they're looking at a 5-year approach. So you might, as an equity investor in the public market, say, look, copper stocks, right? Whereas they're going to buy it, they're going to hold it, they're going to grow it, and they're going to do it over 5 years. So they've got a ton of time to take this thing public. Yeah. Right? Whereas if you just happen to invest it in copper, like let's say last year, you're probably doing pretty badly right now, right? Mm-hmm.
So essentially you're saying and suggesting taking a little bit maybe more of a longer term approach.
Exactly.
What you're also suggesting, though, is that if you're suggesting to go outside your comfort zone, or what you have always heard about, which are equities and bonds, and given the valuations and what we're talking about, you probably want to go outside that zone. At the same time, the opportunities for some retail clients are a bit difficult sometimes in terms of getting access to these products.
I think there's more and more that's coming online that retail can invest in. So I guess one of the key changes that's happened over the last few years is if you find a financial advisor who's a portfolio manager, even though you're not accredited, meaning you have $1 million, that portfolio manager can accredit you. So you might only have, like, say, $300,000, but they might say, look, this client, based on suitability, their risk criteria could take on, say, 5% in these alternative assets. I mean, obviously, it can load you up, right?
Yeah. And Jay, what you're also suggesting is that you've got to look for other places to get your returns, to generate alpha. Yep. From your perspective, what's the number one area to generate alpha in right now?
For us, I guess we do something a bit more unique. So, we like the convertible debt space. Okay. The unique part of what we do is we just privately negotiate our own deal with the company. So we'll go to a public company and say, look, instead of you guys running around the street trying to raise $10 million or $5 million, we'll do it as a one-stop shop. You come talk to us, we'll negotiate terms and a deal, and we'll strike that. So we end up actually getting preferential terms on that stuff, and we end up getting a much higher rate of return.
And what kind of return are you guys looking for when you're doing this?
Our average rate of return on the hedge fund itself has been, I think, like 42% a year for the last 5 years. On average, we're looking at somewhere between like a 10% sort of coupon and then sort of equity upside on the remainder. So, we're targeting, say, 20% a year.
And just lastly, what kind of sectors are you finding these returns in? Obviously, you're good at doing the deal.
Right.
Like that's the key takeaway. But what sectors other than that?
The sectors we try to approach on is, I mean, we've been in technology, in mining. We're across the board, really.
In Canada?
In Canada and the U.S.
Okay.
Yeah.
All right. Jay, good to see you. Thank you.
Thank you so much.